Welcome to this episode of the Bear Ventures podcast, where we open the book on venture capital and give you a seat at the table. My name is Samir and Jake, and I'll be your host today. And joining me today is Jake Yormak from Story Ventures, a pre-seed fund based in New York City, targeting all things data automation. Welcome, good sir. How you doing?
I'm doing well. Thanks for having me, Samir.
No, I'm excited. For anybody that knows you knows this is going to be a very fun episode. So we'll try to make it constructive as well.
You got yourself a deal.
Okay. So one thing I love to do, Jake, is when we kick off, just to learn a little bit about your background and the fund Story Ventures, if we can go from there.
Sounds good. So we started Story 5.5 years ago now, which is sort of crazy to think back on. My background beforehand, I actually was a lawyer. So I worked at a firm called Cravath, Swaine & Moore in New York. I focused on mergers and acquisitions, capital markets, and leverage finance. And then I moved from Cravath to Gunderson, where I specialized in early stage startup tech companies. It was, I guess, around 2014, 2015, when there was a pretty big sea change from corporate world to tech world in New York. It was not the very beginning, but towards the beginning of it. Started Story with my brother, Brian. So Brian's background, he and I both went to Penn for undergrad. He had done investment banking, and then he actually was recruited out to Detroit by a fund called Fontinalis, which was started by Bill Ford, who's the chairman of Ford Motor Company. So he actually lived in Detroit for a few years, focused mainly on self-driving vehicle technology and a lot of the other technologies that were enabling automation in transportation and the movement of people and goods. And that's the brief background on how what we did before we started Story.
No, that's exciting. And so Story Ventures now, I think, is a culmination of all of that, is a data-focused fund. And you talk a bit about how, everything is now needed to really focus there. So everything from sensory to aggregation to really using that data. So can you tell us more about, how you came to that kind of a conclusion and where you focus now?
Sure. So I think we were lucky in certain respects, which is when Brian was working on self-driving vehicle technologies, it was, like I mentioned, around 2014 or so. It was around when GM acquired Cruise for $1 billion. Brian had helped work on a deal called Nutonomy that was acquired by Delphi for about $500 million. Mm-hmm. And it was one of the first industries where there were billions of dollars being poured into the technology to enable autonomy. Very early days of it. You can see now we're 7 years later and we're still questionably 7 years out from self-driving vehicles. And what we sort of felt, though, was the technology stack that was enabling autonomy in vehicles would have a profound impact, not just on transportation, but on other industries. So Brian was focused at the time as well on logistics technology. So let's say robots in warehouses, like Kiva that was acquired by Amazon years ago. But we also thought it would impact finance and healthcare and energy and agriculture. And I probably sound more articulate talking about this now than we did 5.5 years ago when we raised our first fund. It was more of like a fuzzy notion around data and automation technologies that's crystallized a little over time. And anyway, so I can go into the components of that tech stack, but at a high level, that's how we thought about it. It was extrapolating from what we saw as the enablers of autonomy in vehicles and thinking about how those technologies would impact everything else.
Yeah, no, you mentioned 5.5 years ago, starting the fund and what, technology and data, the intersection that looked like back then. Can you share a bit about, fund 1 and 2, you've definitely done a great job of implementing in the space, but, how have you seen the industry as a whole change from then until now as it comes to data automation?
That's a good question. So, when we started, we were young, right? We were 28 and 24 when we started our first fund, and our first fund was really small. It was a $5 million fund. It was all about hustle. We started the fund, I guess, because we saw this world of data technologies, automation technologies, and in New York at the time, which is where we're based and where we're from, there were very few investors focused on it. So I'd say pre-seed, early seed stage in 2016 is extraordinarily different from what it is today. So that's, I guess, there are two domains. One is just VC in general, how that's evolved, and then two is data or automation technologies in particular. So VC in general is entirely different. I think when we started, I remember getting invited to dinners of GPs in New York, and these were the GPs of First Round, ENIAC, RRE, and me and Brian. And
I think you guys deserve a seat at the table.
oh, we definitely did not deserve a seat at the table at the time, but we convinced people that we did, or they were just desperate for more people. And I have funny stories from freaking out at those dinners and not knowing answers to questions that a GP probably should know the answers to. But it's very different now. Now there are, I don't know, probably we're talking about in the tens or even hundreds of VCs in New York specifically. And the environment is, or the ecosystem is much more mature. It's still not mature like the Bay Area is, but it's much more mature. And the pace of company creation as well is staggering compared to what it was a few years ago. So I can dive into that more, but that's the VC ecosystem. And then from data and automation technologies, I'm actually surprised still at how few funds focus on that in New York. So in the Bay Area, there are a bunch of funds as well as angel investors, and it just feels like still a more technical ecosystem in the Bay Area. More in terms of volume, more technical founders. There are just more people who are spinning out of like Google and other technical companies, and more investors that either were operators or just have a technical underpinning. In New York, there still are a very small amount of funds that I'd say exclusively focus on those kinds of technologies. So at the pre-seed and seed stage, I mean, I think there are only, I don't know, 2, 3, 4 other funds that I think we see deals, see the same deals at regular intervals. So it's still in the early days, I'd say, for data and automation technologies, specifically outside the Bay Area. So, which is good. It feels like there's a lot of alpha to create for us. And from a reputational standpoint, the fact that we've been just focused on this for 5.5 years now, it probably actually gives us a leg up in working with those entrepreneurs.
Yeah, and I'm glad you bring up New York. I spent many years, as you know, working in New York across different venture funds, and a lot of people point to a few key differences amongst what you see in the Bay Area and West Coast versus East and West Coast. Not to start that again, but a few key differences on how we do things out here. And I'd love to get your take on the types of founders you see, types of valuations you see. Are things really that different from coast to coast? And what is your focus? I know you guys have a very unique focus geographically, so let's touch that as well.
So we focus mostly on New York and then areas that are not the Bay Area, not because we don't like investing in the Bay Area. We have invested in the Bay Area, but I no reason to think we have a competitive edge investing in the Bay Area. Like, we're not there. We don't have as robust of a network there. And there are so many investors in the Bay Area that it's very hard to find, let's call it, diamonds in the rough out there. There are still relatively few investors focused on automation technologies in New York and elsewhere. So I think about 70% of our fund is the portfolio companies are based in New York. And then 30% are in areas that we sort of think of as having strategic advantage. So an example would be Freightwaves, which is based in Chattanooga, Tennessee, which is sort of the capital of the freight and trucking industry, which I did not know about prior to investing in Freightwaves, but is the case. We invested in a data center, modern manufacturing and services company that's based in Aurora, Illinois, outside of Chicago, because there are a lot of data centers in that part of the world. We invested in like high-level supply chain transparency company based in Texas, because that's where FedEx and UPS have really big offices, and this person, the CEO, was a VP at those companies. So we do areas of what we call strategic significance or advantage, and then we are starting to do a little more hybrid international plus US. So in our new fund, we've made 4 investments, about to make our 5th investment, and 2 of them one is an Israeli company that will be Israel plus New York, and one is a Polish company that'll be Poland plus either New York or Chicago or Texas, TBD. So, that's how our focus has evolved in terms of geo for what we're actually investing in.
Yeah, and it's not dissimilar from what you hear from a lot of funds where, even when I was in New York, we were called a non-core market. Now, how New York City is not a non-core market is beyond me, but everything outside the Bay Area was really a non-core market. Then you had Boston, and then New York came up, and now these emergence of new cities like Austin and Miami and others coming up. But the Midwest is another area of focus, and you mentioned this as well, but that a lot of people are looking to. So it's exciting to see how, especially with COVID, things have really accelerated for those markets.
Yeah, I mean, it's really interesting because It is funny. Nobody has said that to me in a while, or to Brian in a while, which is that New York is a second, like, sort of a tier 2 city from a venture standpoint, but everyone said that 3 years ago, let alone 5 or 6 years ago when we started raising our first fund. It's definitely not anymore. I mean, the pace of company, New York, it was just a matter of time for New York. There is a denser group of talented people here than anywhere else in the United States. So we always felt it was inevitable. And it was, when we started, I would say one of the reasons was both of us had gone to Penn, which traditionally sends everyone into consulting or investment banking or law or medicine. And it was about 5 or 6, probably 6 or 7 years ago was the first time that our friends were switching from traditional financial services to technology. And so it felt like it was just a matter of time. And then in terms of your question about East Coast and West Coast mentality, I would say that the valuations are different, which is bizarre because capital travels really easily, but seed stage or pre-seed and seed stage capital doesn't travel as easily because so much of it is network based. And I do think founders genuinely prefer having investors that are local because it's a lot easier to go get a coffee with me and talk about having an issue with a co-founder, talk about how to recruit that CTO when your first CTO isn't working out, than it is to do it on the phone all the time. So I think there's an inherent advantage to being local for pre-seed and seed, which means that the valuations really are not the same in the Bay Area as they are in New York. And in terms of a mentality, I would probably say the biggest difference, I'm curious if you see this too, but is New York investors in particular are a little more, it feels like a little more commercially grounded and a little more disciplined with valuations, which might not be a good thing, by the way. It's just a thing. It's not extreme. Like New Yorkers are able to think big, and Bay Area VCs do care about the tangible reality of what's happening. But it strikes me that there is a little bit of a difference in terms of how much I would say West Coast VCs value vision investing versus how much New York or elsewhere VCs value having validated something or other over time. So I would say it's not an extreme difference, but it is noticeable. Do you see that?
Yeah, I think definitely more so in the past, this was 5+ years ago, but that was very much the case. I think, we in New York, at least, used to almost poke at those in the West Coast and say, oh, we got this thing at, a few X below what we would have paid over there. And I'm starting to see that level out a bit. I definitely agree with your point of, somebody can quickly grab coffee with me or, they have access to me and I've had a drink with you, Jake. I know it's a good time. So that's definitely a value add, but, I'm seeing that level out a bit. And you're seeing valuations going up across the board. And now with the emergence of these, massive seed funds from these late stage investors, I do see that continuing to move towards that direction. But value add of somebody local is a big important topic, and especially now I'm based in DC, and if you see there's a lot of companies here which end up having to move to where their investors are. It's something I'm trying to change locally here, as are others. But it's what we used to see in New York, and that's really no longer the case.
Yeah, I would say the question around rising valuations is probably the biggest question that we get now as we're about to close our new fund. I'd say that's probably the biggest question we get and the biggest thing that we talk about internally as a team when we're evaluating how we think about investing.
Yeah. And you mentioned pre-seed a few times, and pre-seed versus seed, and there's a bunch of terms, mango seed and this seed and that seed. But can you tell the listeners who might not know what pre-seed is? How does that work?
That's a good question. I mean, because it's so amorphous. So I would say if I were actually describing how we invest, I would probably call it like seed phase or seed stage, which would incorporate pre-seed, but it's definitely pre-validated product market fit. So right now in this market in particular, if you validate product market fit in a big enough market, it's not hard to raise a Series A. It's very hard to validate product market fit. So it is very hard to build a business that raises a Series A, but that's the clear inflection point. So post product market fit validation is definitely Series A territory. Pre is what you call pre-seed or seed. And some companies get the benefit of the doubt if it's a really strong founder or really competitive narrative storyteller. The company might be able to raise prior to, let's call it validating product market fit, be able to raise that Series A. So in the world before product market fit, I would call pre-seed an idea with a founding team or a founder, maybe a prototype if it's easy enough to build a basic prototype, which was probably traditionally thought of as a friends and family round or an angel investor round. And usually I would call that anything 1.5 million or below in capital raised. 3 years ago, I would have told you it was raising less than $1 million, but now you see pre-seeds at 1.5, maybe 2 million. I mean, I got the funniest email this week. I hadn't seen this, so I just told Brian we were cracking up about it, but I got an email for a company raising a pre-seed extension. And I was like,
it's easy to just call it an extension. Yeah.
Or just call it a seed round.
Yeah.
I don't know. Like a pre-seed extension implies that there will then be a seed round and then be a Series A. And this was a note I got from another investor who said one of our portfolio companies is raising a pre-seed extension, which I thought was pretty cute.
That's the first. I haven't heard that one before.
Yeah, it got me too. So I would say that's how I think about pre-seed, is really probably more the amount of capital being raised. A seed round is so variable at this point. So a seed round can be anything from $2 to $3 million that really looks a lot like a pre-seed, just raising a bit more capital. And that still might be just a founder or a founding team with an idea or a basic prototype. But you also see seed rounds where there is, let's say, a company's at 5, 10, 15, 20K of MRR, clearly needs more money to get to the next level of, like we're calling it, validated product market fit. And those seed rounds can be anything from 2.5 to, I don't know, 5 million, 6 million. It's really crazy. But the big thing that I would say people or founders seem to be under the impression of, but I don't actually think it's very true, is this notion of, let's say, 100K of MRR or 1 million of ARR to get to a Series A. What I see in this market, at least, is that Series A VCs are much more invested in momentum than they are in the absolute metric. So if a company goes from 10 to 20 to 40 to 70 in 4 months, that company probably will raise a slam dunk Series A, whereas a company that spends 2 years getting to 100K a month, or I guess that would be 1.2 million in ARR, that company often struggles to raise a Series A. So I would say it's more about showing Series A investors that you've validated product market fit with growth levers and a repeatability or a repeated process that you can roll out with more capital. Anyway, that's how I think about the seed versus Series A stuff.
And I definitely appreciate that overview, and I couldn't agree more. People ask all the time, what is an A and what is a B and what is a C and what is a seed, but those lines are kind of blurred now, and it's tough to call something a letter just by where it is. And I think, and you might have heard the same, but people now start to refer to companies based on what progress they've made versus just a letter, because even the valuation sizes there's no bucket for all of them, and you've seen a wide range of how that looks.
For what it's worth, it's even challenging when we're advising our portfolio of startups, because we have multiple companies right now that, let's say, they've raised $1 to $2 million usually, or $1 to $3 million, and they sort of called that a pre-seed or an early seed stage round, and now they're ready to raise more, and the right fundraise amount is around $4 to $5 million or $4 to $6 million. That definitely 4 years ago was a Series A. Now that's maybe a normal seed round for certain companies, and they don't know how to brand it. So in the pitch deck, should it say a seed round or should it say a Series A? I don't know the answer either, actually. We've started just removing that language and saying we're raising $4 to $5 million. But it's actually challenging because it's so unclear. I don't think it matters so much, but it does have some, like, if a company raises a $4 to $5 or $4 to $6 million round, regardless of what we called it going in, we would call it a seed at this point, because it just feels good, right? It sounds good to have raised a really big seed round. It's good for maybe recruiting because it seems like a hot company and employees are attracted to that. It puts us in a position that we can raise a $10 million Series A if we need to, or if we're ready, we can go for a $20 million round, but it gives it a little more optionality. But figuring out what to even call around these days is actually hard.
That's exactly right. But one thing is clear is that you at Story are first check investors, and whatever the name is, let's just call it pre-seed, your first check in. So Tell us a bit about what it is you look for first check-in. There's no, real numbers, or usually not, a bunch of numbers and KPIs to go off of. The track record, it might just be an idea at that point. So what is it that you guys base your work off?
That's a good question too. So yeah, we're usually the first check-in or in that first round. We think of it as, I think actually it was Satya Hunter at Homebrew did a good job of this, which is calling it investors of record, taking board seats at the companies, leading around, setting terms, giving term sheets out to companies. In terms of what we look for, generally just attractiveness of the founding team. And I'm kidding. I would say that for us, it's in the sweet spot of automation and data technologies. It is usually either a technical founder or very often for us, a commercial founder who has a technical co-founder. So there's definitely a spectrum of the companies we invest in that are more technical to, let's say, like it's technical-ish, but it's not overly technical. So we have invested in solo founders and or founding teams that don't have a CTO yet, but have an idea of who that CTO or who that VP of engineering or head of engineering will be. So we don't always need that, but most often we want to see a combination of commercial orientation and technical orientation. So that probably is the most important thing. And then I would say we, maybe more than most, are obsessed with detail orientation, and that could be the lawyer in me coming out a little bit, but I'm not kidding. Like if I see grammatical errors in an email, we just won't invest. Like which a lot of people definitely will not agree with in the technology world. But it's so hard to start a company, so hard to build a very successful company. It requires so many skills. And you've got to assume the founders are putting their best foot forward when they're fundraising, which is an existential need for a company. So it's detail orientation, it's combining the commercial and technical know-how, or if it's not that technical of a business, at least showing us evidence that the founder will be able to recruit really strong technical team. And from a prototype standpoint, sometimes it is just an idea. We tend to invest in heavily regulated markets. So it's hard to have a prototype or beta users, for example, in a lot of the companies in which we invest at that stage. It's hard to just stand up an MVP and get started if the company needs to be HIPAA compliant or is dealing with sensitive data, for example. So sometimes there's a prototype, and then we're just looking for, I would say the biggest change was we used to invest in people that I would have called more, let's say visionary in a certain way. You always have to have a vision as a founder, so that's really important. But I would actually sacrifice vision in exchange for competency at the early days and a really concrete view of what it is that's going to be built. And then the last thing I'd say, I'm rambling a little bit, is that we think about valuation a lot when we invest in the early stage. And the way we think about it is we only will invest if we can see the company with the capital from this round getting to a 3x net valuation prior to at the next round of financing, which is hard because if you do a pre-seed round, even if you do it at what's probably a sort of low valuation in this market of 5 million post money or 6 million post money, that means that if the company raises a seed round, it has to go off at a 15 to 20 million pre-money or better, which is actually still really hard to do. It's doable, but we're really aggressive in how we think about the need for a company to have a big jump prior to the next round, which means that we tend to invest in companies that are at or near an inflection point. So we do idea investing, but if we're going to do idea investing at this point, it's a company that can be capital efficient in getting that idea off the ground, or the market or opportunity is so huge that some investor will pay up for it. But I'd say more often it's about efficiency in those early days, or it's a company that's raising enough money that it has the runway to still be efficient, but actually invest enough to hit that inflection point. We obviously are not always right. I mean, some companies don't even raise any follow-on capital, but it's a pretty high bar, but that's the bar to which we hold ourselves when we evaluate a deal.
Yeah, and I like that you brought up, some of the companies having some sort of regulatory hurdle, but that hasn't stopped you in the past. And I've had the pleasure of the portfolio with you, and you've certainly kind of stayed true to your word. And there's also companies which, quite frankly, other early investors might shy away from just because of how capital intensive the business might be, or it's not the normal line of what most people might look at. So, it's exciting to see how you've kind of thought through that. And so, seeing things like this, regulatory hurdle, or it being a very capital intensive industry, or, I don't want to call it a not normal industry, but one where most early investors would shy away. How do you get that extra level of comfort, so early on?
That's a good question. So, well, there are two aspects. One is like what we've proactively done to get comfortable. So as we've built our fund, so our first fund was $5 million, our second fund was $25 million. We're about to close this new fund, which will be in the $40 to $50 million range. And we've thought about, from a platform standpoint, like, how do we build Story Ventures, the organization, knowing that we invest in all these highly regulated data and automation businesses. So we actually, the first thing we did, which is, I think, unusual, if not unique, is we started an advisory council of lawyers only who have experience in regulated industries and specifically have dealt with data privacy, data security, data mapping issues. So that includes lawyers from companies like Peloton and ZocDoc and Uber and Epic Games that deal with a lot of sensitive consumer or customer data. And so we now assign each new story portfolio company to one of those advisors, whoever has the most relevant background, to be not the lawyer. These companies still have lawyers, but to be the guide around how to deal with regulations and data. So that's one thing we proactively did. But what I would say in terms of not proactively, more just how our thinking has evolved, is we really like investing in regulated industries because they're harder to penetrate. The moats are often bigger. But it's probably why we're so insistent on detail-oriented founders versus just vision-oriented founders, because dealing with HIPAA compliance is one thing. It's not easy. But then you realize HIPAA is just sort of a loose set of standards, and that's actually not good enough, right? So HIPAA compliance might be table stakes to getting patient information and maybe partnering with a large healthcare organization. But then how do you think about your employees having access to all of the sensitive data and the fact that they're talking about it over Slack, which is not the most secure channel for that kind of information? And I think it's why we've optimized or indexed towards founders who are extremely detail-oriented, commercial-minded, and thoughtful about how to build those businesses, because there is no way to truly speed up and break things in a highly regulated business. And if you do, you could succeed, but there's a lot more risk to doing it that way.
Yeah, and how do you think through your value add, as such an early investor for these companies? It's really not just the capital that they need, but the experience and the mentorship and the network. So, how do you think through, day one, and then, they raise another, one or two rounds of financing, how that role evolves over time? How do you really work with these founders?
Well, we know all the good bars in the West Village. So
that I know.
I would say it is different for different companies. So at the most basic level, there's definitely just an empathy to have for founders. We started Story, and I do actually think, like, there are great investors who've started funds and great investors who have joined funds, but from starting you have to really go through a ton of crap to start a business, whether that business is a venture capital fund, a fund of funds, an operating business. And so there is a lot of empathy that is just important, like a baseline human empathy. For us, we have a very concentrated fund. We only do about 12 companies per fund. So we do that precisely so that we can get very involved in companies and take board seats and actually move the needle, hopefully, theoretically. And so I would say there's definitely a lot of experienced knowledge from the reps we've had. So the questions that founders ask, they're definitely not just patterns, but like literally repeated questions. So I'd say things, just as an example, non-technical founders struggle with either finding a technical co-founder or hiring technical people. And once a company is, let's say, Series A or beyond, you have a recruiter in-house and or a robust enough technical team to do it. That's a very common problem. In the early days, we didn't know that much about it, but 5.5 years of doing anything rigorously, we've learned quite a lot about it. There are for example, when companies think about direct to consumer marketing and are thinking about hiring ahead of growth, seeing how often that hire is a bad hire because, again, the founder didn't really know that skill set, and then helping, let's say, interview that person, helping do reference checks, helping to save, let's say, 6 months of what is often wasted energy if you hire the wrong person for a key role. So there's some just like strategic guidance around things that we've seen done, which we couldn't have done a few years ago. And now I think to an extent we can. There is strategic value around data, which is really helpful. So it's not just the advisory council we put together of lawyers, but it's understanding how to think about data mapping strategy in the very early days. It's reinforcing the importance of, let's say, cybersecurity and compliance in the early days, which is hard because founders don't have the bandwidth to think about anything other than like mission critical. How do we get our next customer? How do we hit our quarterly goals from a revenue standpoint? But then we see the point at which that bites companies in the butt, whether it's a fraud or a whole host of other issues. So it's trying to use our experience to balance helping founders understand what they need to be on the lookout for, but also not stunting the business because it is not the mission critical thing in the early days. So there's a lot of learning. And then we do dinners actually in New York a lot now. And that can, the first big session we did was with data aggregator founders. So, Plaid, for example, and probably most people listening know Plaid, which is a financial data aggregator. We invested in the equivalent company in the connected vehicle space, a company called Motork. We invested in a company called Particle Health in the electronic medical record space. We've invested in a bunch of these businesses, and actually just getting founders together across different industries, but with the exact same themes is immensely helpful, not just for us as investors to build out our framework, but for each of them to ask questions of one another. And so we do that whether it's data categories or data business models across industries, or then data within an industry. So last week we hosted a healthcare leaders dinner for a bunch of different healthcare founders who are dealing with similar sensitive data issues, as well as regulatory issues, whether it's how to get payers to pay for something or how to think about billing codes coming from Medicare or Medicaid, for example. So it's a long-winded answer because it's not the same for each company. I guess what I'd boil it down to is there is a network effect of venture capital. And if you can manage to build a fund that survives for 5 years or more, you can start to benefit from it as the GPs of the fund, and the founders can really start to benefit from it as well.
Yeah, now, a founder once told me that money all spends the same. So what else comes with this, right? And I think that was a key piece that, a few years ago I thought was crazy, but now I truly see the importance, as it sounds like you do as well, of being more than just capital, being a partner for really the most pivotal early stages of growth.
Well, if you want a funny story, so one of my good friends is founder of a company, and we were at a holiday party, and it was not his VC's holiday party, but one of the VCs, the partner of one of the firms that invested in his company, who I'm good friends with. We went up and said hi, and I shook the guy's hand, just said, "Hey, how's it going?" And then my friend went up to him and he introduced himself to my friend, who's a founder of one of his portfolio companies, and my friend, sort of teased him and was like, you probably should know who I am since I'm a founder of one of your portfolio companies. And the guy was all apologetic and everything. And my friend goes, "Don't worry, your money's just as green as everyone else's, and we accepted it into our bank account."
I'm glad that still worked out. And look, it's clearly the difference of funds like yours, where you truly partner at the early stages, and shifting a bit from portfolio to the fund in itself. You're in the process of closing out Fund 3. You've done a tremendous job with Funds 1 and 2. You've stayed true to the story the entire time. What is the future of the fund? What would you like to see come out of story, not just 3, but 4, 5, 6, 10, and beyond?
That's the hardest question. We get asked that when we're fundraising, and I have variations of the answer, which is more to satisfy LPs than it is the truth. I would say the truth. So hopefully none of our prospective investors are listening to this, but I would say the truth is that Brian and I pride ourselves in being really nimble and trying to understand where the opportunity to create alpha in the market is. And that is our job. And right now, the markets are incredibly frothy. I look at, let's say, so start with fixed income, which is really hard to invest in a, let's call it high inflationary environment with low interest rates. So that's off the table. You look at public equities, which have pulled back some, but they're very possibly overvalued, but it's unclear. You look at growth stage venture capital, or even Series A, Series B, and beyond venture capital, the money is flowing in and the valuations are really high, and it could be a tremendous vintage. It could be underperforming vintage because of those valuations. The hardest place for capital to get to is really early stage. It's hard to network, to find these businesses. It is exhausting and hard to create these businesses. And that's not just for the founders. It is for the founders, obviously, but it's also for the investors who are on the boards of these companies. And our job would be a lot easier if we did Series A or Series B investing. We are both tired of having done almost 6 years of pre-seed and seed stage investing. But when I think about it right now, that's where we can create the most alpha. We can find deals that are undervalued. At least we think they're undervalued. We can find businesses, founders who have a vision for a company that is a few years out. So they are those things we're looking for: detail-oriented, commercial-minded. But because the market doesn't even exist yet, most investors don't give them credit for it. So right now, the answer is there's alpha to create in the very early stage, and that's what we do. Will that change in a few years? Probably yes. I don't know what it will change to. But so when I think about story, this is the truthful answer, which is not that helpful because it's so ambiguous what I'm saying, but it's how do we prove that we're good enough at what we do to build a fund that maintains flexibility to do whatever it is that we think is best at that point in time. And that requires us probably focusing more on building our organizational muscles than, let's say, like specific investment type muscles. So rather than, let's say, spending a lot of money on analysts who can get really good at an early stage, which we will do, it's how do we think about having, chief of staff at our firm? How do we think about now hiring a general counsel at our firm to give us the organizational strength to move as we see the market moves? And what that looks like, I'm not quite sure. And then the other aspect is thinking about how do we over time decentralize the decision making in a sense? How do we make it so that Brian and I are not just the bottleneck to everything that we do, which we currently for the most part are. And that's okay because we're still a small enough organization to do that. But so right now we're toying with, for example, do we have story angels, which is we allocate a portion of our fund to technical founders of our portfolio companies or other companies to see how they do as angel investors, both as lead gen and just as a decentralizing mechanism for what we do. And so for the first time with this new fund, it's big enough that we can hire that organizational strength to actually toy around with those ideas that we've had for years, but we just didn't have the resources to do anything with. So I'm hoping that I'll be better able to answer that question granularly in the next year or two. But the overarching one, which is not that satisfactory to LPs, especially LPs who think about venture as a product, which I imagine you do to an extent, is that we just want to be the best. And being the best means that we have to be flexible, because if you're just going to do the same thing over and over again, it's very hard to maintain that edge.
Yeah, no, I actually agree with you on that, because in the world of investing, and especially at the early stages, it is evolving day by day, second by second. So to keep up with that with the same strategy from many, many years ago or a decade plus ago, it is tough. You've seen it done for certain industry verticals, but oftentimes you will see managers emerge. You've gone through the hard part of fund one for a fund manager is a very, very tough process. Fund one and fund two is behind you now. Those are really the emerging stages for a new venture program. And although a newer fund, now at fund three, you've proven that the model works, and more importantly, that you two as founders of the fund work. So, I applaud you on that, and look forward to continuing the journey. Jake,
one thing I'll add, just because if you're curious, is a tangible example. So we did a deal 2 years ago, and the founder of the company, the CEO, was coming out of the exact industry. He was essentially doing a rinse and repeat. He was the general manager of a business line that was very profitable and lucrative. And he wanted to raise capital at, let's say, like a 20 million pre-money valuation out of the gate. And this was before the market had gone bananas, where that sort of is the norm. And we're a smaller fund, and so we're sensitive. And so we essentially said, there's no way we would do that, but we do want to invest. We did our diligence. We really wanted to work with this team. We proposed valuations in like the single digit millions. We said what we would do. There's nothing right now other than the two founders, including like very impressive founders, but there was nothing, and it would take about a year to stand up this business. And so we said we'd do it at a 6, 7, 8, 9 million pre-money valuation, but that was stretching it for us. And they said, we're not going to do that deal. We're going to try and just raise angel money then. And what we ended up agreeing to, which is very unusual, is we agreed to expose 50% of our seed equity for the whole round, not just us personally, but for the seed equity to be repurchased at a fixed premium to the price at which we enter the company. So the idea is, let's say we entered at an $8 million pre-money valuation and they raised a couple $1 million. They had a window 2 years out to 3 years out to repurchase half of that equity at around a 3x multiple to the price at which we entered, with the idea being that if they outperformed, then they sort of truly, in retrospect, justified that higher valuation in the early days, which we weren't going to give them. We would still get our cost basis off the table plus more, and we would maintain 50% equity in that company, plus the pro rata ability to follow on in that business. As it turned out, two things happened. One, the company has done exceptionally well. I mean, this is the fastest growing company in our portfolio probably, but within 2 years of investing, they're doing over 3 million a month in revenue. So that's awesome. Two is in retrospect, they were right in trying to get a higher valuation in the early days. Three is it's okay. It works out because while it's, I would rather them not repurchase our equity at a 3x multiple when we probably were marked at a 20x multiple now on our initial investment. They earned it, and that's okay. And then four, what was very interesting is that they actually overraised in that initial round. It's a capital intensive business, and they raised, I think it was like $6+ million at around an 8 million pre, right? That's almost 50% dilution in the company. They were that confident in their ability to repurchase the equity that they did that. And what that enabled them to do was then they were able to raise 5 million of debt because they had such a big equity buffer, and they were able to accelerate their business probably by an additional year in the speed with which they developed it. So it ended up being immensely helpful for the company, which I wish we had thought about beforehand, but it's not why we did it, but it ended up working out really well. When we took that deal to market to find another, that's a lot of money. So another investor to do it with us, every VC said no, because it was such an odd structure that is unusual and not vanilla. We ended up doing the deal with one of our LPs, which is a family office that put a lot of money into it. And it's probably the best performing deal in our whole fund, but it's that kind of flexibility that we're willing to, we actively want to have. And so that's how we think about building the story.
Yeah, no, it's a real testament to what we talked about earlier around being founder friendly, and that is a very founder friendly term. You'll often meet people at the early stages who really sold a big chunk of their business early on, and it might not have been enough, and they went back to market much quicker than they thought, and they continue to get diluted, and investors later on need to find ways to refill those option pools and make them whole to keep them incentivized. But that's an interesting new approach that I actually haven't seen before. Is it something you're seeing more of, or?
No, I don't know. I don't think anybody else is I'm not sure anybody else has ever done this in venture, but probably most structures, it's not the first time it's done. No, and I would say, there's this notion of founder friendly. I ultimately thought about it as like we wanted to make a deal. We wanted to invest. They are good negotiators, and this was the best deal that we could get. And whenever you make a deal, usually the right deal is one you feel pain and the other side feels pain too. And so, we didn't do it. If we thought we could have gotten away with doing it without giving that option, we would have done it. So I don't even want to take credit for being founder friendly, more just like we're good business people, and we're not going to figure out what the right way of creating value for the business is. Much of that value accrues to the benefit of the founders. And if there's a way, like in this instance, where the founder can bet on himself or herself, in this case, they were betting on themselves, we're open to that because I think it does align incentives in a certain way. But no, I think it's unusual, and it actually is a model that, as we invest in capital intensive businesses like modern manufacturing, robotics enabled manufacturing, or any other kind of tech enabled services business, I actually think it's a very good model that we will replicate. I don't know if others will, but we like it a lot.
Maybe after hearing this show, they may, but it is a unique approach, especially the early stages, especially now. I think we need more and more of the cookie cutter term sheets are already becoming a thing of the past, and it's items like that that I'm always excited to hear about and learn more about what people are doing.
Definitely.
Awesome. Well, Jake, I appreciate the time. As always, it's a pleasure, and look forward to our next catch up. We'll have to drag Brian, your partner and brother, in for the next one.
Yeah, but the humor and witticisms will go up.
that I know.
And the intelligence will, at the very worst, stay the same. So you definitely got to get him on.
Always a good time. But for those of you watching, please do check us out at www.barevc.com. Follow me on LinkedIn and follow the fund as well for new episodes that come up. Until next time, take care.
Thanks, Samir.